and welcome back to Dukascopy TV. I'm Monica Gibson. Annie Balmon-Raccah joins me in the studio right now. Annie, welcome back to the studio.
Good morning, Monica.
It's nice to see you, nice to have you here again. Now, last time you were in the studio with us, we were discussing the sort of major moves of 2013. Here we are a year on. So what have the main moves really that you've experienced or you've been taking attention to latterly?
I would say the answer is in twofold. First of all, we've seen major downward revision to growth worldwide, except for the US, and that has pushed inflation expectation to very low level, even flirting with deflation if we're talking about the Eurozone. And that has, as a consequences, has pushed, and we can see that on the chart, has pushed the CRB index plunging to by 7% over the last 3 months. Also, interestingly, we've seen yields of core European countries yielding negative territory, especially if we look at core countries are like Netherlands, Belgium, France, Germany, and especially Germany, up to the 3-year maturity yielding negatively. It means that investors are paying those governments to hold custody for their money. And that has been also amplified by the fact that the ECB has cut rates, the deposit rates by negative 20 basis points, and that has amplified that movement. On top of that, recently the IMF has released its forecast, and they were quite sanguine about growth. The IMF now expect the world to grow by 3.8% versus 4% previously, and the Eurozone from 1.5% in 2015 to 1.3%. And they do not exclude that number to be revised downwards should inflation rate worsen further. Another worrying trend we've seen among fixed income investors is the credit deterioration of, I would say, high-yielding instruments, especially Chinese issuers have been encountering difficulties, and also among US high-yield issuers we've seen spreads widening. And we can see that also in terms of risky assets, the equity markets are unfortunately back to their level from February 2014.
Now, there certainly is so much going on in the market, but at the same time there's still this degree of wait and see from the Fed, the US Fed, in terms of when they're going to raise the rates. A lot of analysts, a lot of market participants believe they're behind the curve now, and when the eventual increase does come, it will be by a higher margin and therefore a bigger shock to the markets. But with all this going on, what would you say is the biggest risk here?
Absolutely. We had the release of the FOMC minutes last week, and there is no doubt that the FOMC participants are worried about the worsening of the global economic outlook, as well as their currency, the dollar, strengthening. And you can see on the chart as well that the dollar has been strengthening by 7% over the last 3 months. And that is also pushing inflation rate lower. And that really will refrain the Fed from hiking rates soon. Therefore, we can see that market participants, and this is the Fed Fund futures contracts, have scaled back their first right expectation from July 2015 to September 2015. And honestly, we cannot rule out that the market participants will completely rule out any rate hike in 2015 if that trend continues like this. You were talking about being behind the curve. Yes, we are a bit, we believe that the Fed might be behind the curve if they wait too long before hiking rates, and the more they wait, the more aggressive the pace of hiking will be. And you and I and the audience know what will happen. And remember the duet Bernanke and Greenspan 10 years back when they were holding and maintaining interest rates at very low level. We all know what happened after that.
Indeed. Now, it does seem as though the goalposts are being consistently, moved, as it were. But so with all this in mind, all this uncertainty, how have you at KBR been advising clients to position portfolios accordingly, really?
Yeah, we have advised our clients to reduce the allocation to, I would say, risky fixed income sub-asset classes. And among those instruments, I would say reduce the deeply subordinated financial instrument as well as the low-rated paper. as we believe that at one stage the Fed will start hiking and those paper will suffer. Also, we have recommended investors who can do that to short the long end of the curve, as we believe that both the term premia and interest rates will have to rise. It's interesting to note that the fact that the quantitative easing has completely taken out the duration risk of the market, and that's very dangerous. That is really true for the US. Also, there is a trend which is very interesting, is that you can see here on the chart, you've got the spread between the 10-year US Treasury and the 10-year German Bund, and the spread is yielding almost 140 basis points. It is a very wide level in terms of history, and that is a consequence of the deflation fear, in Europe, pushing investors to take, I would say, advantage of the rate differential between the US and Europe, so positioning themselves at the long end of the curve, and also taking advantage of the currency strengthening versus the euro. We do not expect that trend to be sustainable, as we believe that both inflation and growth prospects are much better in the US, and at one stage the Fed will have to start normalizing its monetary policy.
Indeed, at one stage something's got to give, surely. Sure. But Annie, thank you so much for coming in and sharing your sights with us. It's been an absolute pleasure. Thank you.
Thanks, Monica.
Thank you. Okay, well that's all from Annie and myself for the moment. There's plenty more coming your way at Dukascopy TV, so make sure you keep clicking back for the hourly updates. Goodbye for now.